So when crypto's price isn't working, crypto traders are trying to find things that are working. And I think the biggest trade over the last 6 months are gold and silver. So I think gold and silver's rise, and there could be fundamental reasons, but the price momentum there has, I think, drawn money away from crypto. This is a sign that the dollar is about to crash, or there's geopolitical risk, or something's wrong with the plumbing, like that there's going to be some bodies floating. And a lot of people think it's going to be a commodity dealer or a major bank that's short one of these things that's about to have a huge capital call.
For more than a decade, Bitcoin markets have been interpreted through the lens of a 4-year cycle. This framework, rooted in Bitcoin's halving schedule, has shaped investor psychology, capital allocation, and market timing strategies. Entire generations of crypto participants have internalized this rhythm as if it were an immutable law of nature. Yet markets evolve, participants mature, and macro conditions shift. According to Tom Lee, what we are witnessing today may not be a simple repetition of prior cycles, but rather a structural deviation that challenges one of crypto's most deeply held assumptions. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
Crypto is reflexive of prices. And I think it's changing because now the blockchain, as Dan said, is actually finding a lot of utility. I think there's a lot actually being built on the blockchain. But if we look at historically, crypto drew a lot of its legions of users and actually traders because of price. So when crypto's price isn't working, crypto traders are trying to find things that are working. And I think the biggest trade over the last 6 months, and I can see it from our institutional engagement, and of course, if you can see it on social media, or even just go to Reddit and look at Wall Street Bets, the 2 most traded tickers are gold and silver by a country mile. Like just Google Wall Street Bets, most active, and it's exponentially 10x anything else. And so I think gold and silver's rise, and there could be fundamental reasons, but the price momentum there has, I think, drawn money away from crypto. That being said, I don't know if it's really scary signal, because I think a lot of our institutional clients at Fundstrat think that this is a sign that the dollar is about to crash, or there's geopolitical risk, or something's wrong with the plumbing, like that there's going to be some bodies floating. And a lot of people think it's going to be a commodity dealer or a major bank that's short one of these things that's about to have a huge capital call. I personally just think it's more prices creating momentum. I have 2 observations to make. Number 1, I don't think crypto is viewed as legitimate within most of the key decision makers of an organization. So there's evangelists, like at JP Morgan. I'd say that there's obviously a blockchain team, but like at the senior level, the top 20 managing directors and executive team members, I don't think there's buy-in into crypto. And it reminds me of I used to be a wireless analyst from 1994 to 2007, from when wireless was only 75 million users to over 4 billion. And I remember once Bill Harrison asked me to do a Chase board meeting where I talked about wireless. And I think I was 29 at the time. And I went in and I said, see this BlackBerry? This is going to be more important than that phone at people's desks. And Chase is going to spend more money on cellular than landline. And Bill looked at me I kind of was saying something heretic, because the telecom companies were big clients at JP Morgan and Chase, and so I never got invited back actually at the board meeting. But that is, that was the reality, because wireless basically was a better business than landline. And I think that's true today. If someone went into a bank and said, blockchain offers finality and speed that your current systems can prevent fraud at scale and speed that your systems can't handle, I think you'd get the same look in a board meeting. But there's already proof, because take a company like Tether, which is basically it's a monoline company. It's a stablecoin issuer, but basically operates as a bank. They only have 180 billion of stable coins, tokenized dollars. It's not even 1% of M1. And their profit this year, okay, and I'm projecting, because I don't actually have their numbers, but I think if you look at their GAAP net income in 2026, it might be 20 billion, which would make them a top 5 most profitable bank in the world. And just put a, I don't know, 15 multiple on it, 300 billion, or 20 multiple, 400 billion, that would make it top 5 most valuable bank in the world. The thing is, they have 300 employees because they do everything else on the blockchain. JP Morgan, which is the largest bank in the world, has 330,000 employees. So to me, like, it's, you know, crypto isn't accepted. Things are changing, as Justin said, but I think Wall Street wants to hijack that narrative, but I think native blockchain companies are like open source. They, you know, they may end up being better businesses.
Despite growing adoption, crypto remains largely illegitimate in the eyes of senior decision makers at major institutions. While evangelists exist within banks and asset managers, genuine buy-in at the executive level remains rare. Lee compares this moment to the early days of wireless technology. In the 1990s, wireless was clearly superior to landlines, yet entrenched interests resisted its adoption. Legacy incumbents shaped narratives and regulations to protect existing business models. Blockchain faces a similar dynamic today.
Just recently, at the end of last year, in the Middle East, and meeting with a lot of the original Bitcoin folks, many think there is a 4-year cycle, and that is affecting their behavior. So these folks who've made a lot of money in crypto, and their life cycles have changed because they might have been 20, 15 years ago. Now they're in their 30s and have other life decisions. They've been acting as if it's a 4-year cycle. So some of it is self-fulfilling. But to me, I think there are differences, which maybe want to highlight versus the similarities. The first is usually activity on chain starts to turn down in the 4-year cycle, and that's not happening. Like if you look at Ethereum, active addresses have actually been accelerating higher. Daily activity has actually been accelerating higher. Even total value locked on chain has been going up. That's not what happened in, let's say, even the last cycle. I think that there has been already, an accelerated deleveraging that's taken place. I think October 10th front-end loaded all the deleveraging. I mean, that was a bigger wipeout than November 2022. The thing is, November 2022 was the last cycle low, but the amount of leverage wiped out was bigger on October 10th. So that was front-loading something a year early. And then the last point I'd make is there's a 4-year cycle, but then there's also the business cycle. And I think if you look at like ISM, for instance, actually no Bitcoin cycle has peaked without the ISM peaking. So in other words, this would be a break of the cycle. But part of it is because the ISM's been below 50 for a record 36 months now. It's the longest in 100 years of data for ISM. It's never been below 50 for this long. And then the second is things like gold versus copper ratio, which kind of is a proxy for industrial versus monetary base. Gold, copper has been at a cycle low. Every Bitcoin high has actually coincided with copper actually peaking relative to gold. So I think it could be a 4-year cycle, but then the things that normally link to the 4-year cycle actually are different. So I'm going to be in the camp that I don't think it's a 4-year cycle. So I'm not trying to disagree with consensus, but I think we've already front-loaded a lot of it. I think it's positive in the sense that legislation is passing that's pro-crypto, but in the back of my head, I remember something about the telecom industry, which is the telecommunication industry used legislation and their real deep tentacles into Washington to create structure that favored them over, as an incumbent, over new entrants. So the wireless industry was constantly handicapped and chopped at the knee because the telecom industry used regulatory arbitrage. And there were simple things, sorry for too much detail, but like, these trunk lines, they were called T1s back then, like in New York City, you connect today with, your fiber line to New York, 9X at the time or whatever, that would cost you $20 a month if you were a doctor's office. If you were a cellular company, you were paying $1,000 a month because that was considered terminating access for a competitor. And I think, crypto regulation, it has a risk of being crafted that way, which would handicap the new entrants, but really create favorable terms for existing companies. And I think part of that is why there's, of course, a big battle taking place with the Clarity Act. I'm, again, not trying to express my opinion. I'm just expressing what I've seen in the past. One of the things that I'm sure you guys and your analysts who write about AI are talking about is that as we start to have real-world AI, like robots and different things operating in what they call the wild, that you're going to want fidelity or sovereignty or proof that these instructions are correct, because otherwise someone will just hack into these things and drive your car into your neighbor's house. And a lot of that is probably going to end up on some sort of blockchain. And if it's an open source project, it'll end up on a public blockchain. So to me, that's another use of blockchain and crypto that hasn't existed in any time in the last 4 cycles. And I think that's another potential catalyst as well. I'd love to get Dan's take on quantum risk because, people, I think some of the reasons I found some institutions are kind of wary of Bitcoin is that there's a lot of talk about quantum capabilities accelerating, and of course that can break the encryption, potentially affecting a lot of the many legacy Bitcoin wallets. I don't know if it's 25% of Bitcoin wallets are sitting as bounty for quantum. But just keep in mind, precious metals has its own, quote, quantum risk, okay? And I'm a fan of gold. I'm not trying to knock gold, but keep in mind, gold is not scarce. There's a lot of gold underground. All gold is extraterrestrial. So if when SpaceX does their IPO and then they have money to launch to Mars, Elon Musk might find a gold asteroid. And again, he owns it.
Is that secretly what he's doing all along?
Yeah, he'll have his own store of value. But he'll not only be the richest man on earth, he also is the new central bank. And he's going to just have this cable towing this asteroid into orbit. But of course, another risk of gold is alchemy, because someone may have already discovered a way to knock an atom off to make gold, and those are quantum risks to a precious metal. So I mean, to me, if I was looking at it, and I'd love Dan's take on this, I think Bitcoin is. I agree with him. It is a great way to transfer value. And that is more important than the fact that some wallets are at quantum risk.
Tom Lee's argument is not that cycles no longer exist. It is that the conditions shaping them have changed. On-chain usage is rising, deleveraging has been front-loaded, macro indicators no longer align with historical peaks, and blockchain technology is expanding into entirely new domains. The 4-year cycle may still influence behavior, but it is no longer sufficient as a standalone framework. Crypto is transitioning from a reflexive asset into foundational infrastructure.